and welcome. You're watching Market Cafe with me, Ankita Saxena, and with me is Snehi Shah. This is the show where we get you all the setup for the trading action that is to take place for today morning and what moved the markets globally. But first up, we'll quickly go across and have a look at how the global markets moved over the weekend, or rather Friday, and the last week. Now, Snehi, rather mixed cues coming in there on Friday, but a rather lackluster week for the Wall Street last week.
That's absolutely right, Ankita. Good morning to all our viewers. And as Ankita mentioned, absolutely flat for the US markets over the last week. And stock futures rose slightly on Sunday evening as Wall Street looked to shake off a rough start to August. Futures tied to the S&P 500 ticked up just 0.2%, and futures tied to all three indices logged very nominal gains on Sunday evening. Now, the moves come after stocks have struggled to sustain their rally in the late part of summer. Last week, the S&P 500 and Nasdaq Composite fell 0.3% and 1.9% respectively. So that's a big fall coming in for the Nasdaq. And it was the Nasdaq Composite's first 2-week losing streak of the year. So the Dow Jones Industrial Average also, however, gained 0.6% for its fourth positive week in 5 weeks. Now, the upcoming week could be driven by insights into the state of the US consumer, with earnings report due from Home Depot, Target and Walmart. Retail sales data from July is also due out on Tuesday morning, and the earnings reports are coming after a mixed batch of inflation reports last week, which show that price increases have eased from their post-pandemic peak but are still above the Federal Reserve's 2% target. That was on the US markets then, and let's also shift focus to Europe. And European markets closed lower on Friday as investors continued to digest earnings and the latest US inflation data. The Pan-European Stock 600 index ended the sessions with a downtick of 1.1%, with all sectors in the negative territory. Tech stocks led losses, closing down 2.1%, while autos and mining stocks slid 1.8% and 1.7% respectively. So mixed cues and mixed handover coming in from the US markets, but Europe, Ankita, is largely negative on Friday.
All right, Snehi, let's quickly go across and check where the crude is at right now. Crude prices inched higher on Friday after the International Energy Agency forecast recorded global demand and tightening supplies, preparing prices to the 7th straight week of gains, the longest such streak since 2022. Now, the IEA estimated that the global oil demand hit a record 103 million barrels per day in June and could scale another peak this month. Now, meanwhile, output cuts from Saudi Arabia and Russia set the stage for a sharp decline in inventories over the rest of 2023, which IEA said could drive the oil prices even higher. Now, currently, the oil is seeing a bit of a decline coming in. The oil prices currently stand lower. The Brent crude is at $86.46 a barrel, and WTI is at $82.87 a barrel currently.
Absolutely, and with that, let's also look at all the cues that you should be tracking for this week. Lots of data that you should be keeping on your radar then. And let's look at the US markets. The FOMC minutes for the July meeting will be released today. This is the minutes of the Fed meeting that happened a while back. And the industrial production numbers, that data will also be out today. Let's shift focus to home then. And on the 14th of August, which is today, the CPI and wholesale prices numbers will be out. And tomorrow is Independence Day, on account of which markets will remain closed, and it is a national holiday. On the corporate action front then, ITC will consider a scheme of arrangement for its hotels biz demerger. So important cues to be tracking all along the week, Ankita.
That's right, Snehi. But first, let's quickly move on to news that made headlines globally. Economists at Goldman Sachs expect the Federal Reserve to start lowering interest rates by the end of next June, with a gradual quarterly pace of reductions from that point. They believe the cuts factored in their forecasts are largely led by the motivation to normalize funds rate from the key restrictive levels as and when inflation nears the central bank's target.
And the long-hyped cage match between two tech giants, Mark Zuckerberg and Elon Musk, appears to be no more after Zuckerberg dismissed Musk for allegedly delaying their anticipated showdown in the ring. Remember, the social media executives have been teasing the possibility of a mixed martial arts fight since June and calling it a cage match.
And SoftBank is in talks to buy 25% stake in an indirect arm of Vision Fund 1, according to Reuters. This comes after the bank was preparing to list the chip designer on Nasdaq next month. Remember, if the negotiations lead to a deal, investors in the fund, including Saudi Arabia's Public Investment Fund and Abu Dhabi's Mubadala, would be positioned for an immediate windfall.
Shifting focus then, the deadliest US wildfire in Hawaii reports 93 deaths so far, and officials claim that the death toll is likely to rise. The cause for the fire has not been determined yet, but experts say there might be a possibility of active power lines that fell in high winds led to the wildfire that ultimately spread to Lahaina, a coastal town in western Maui.
With that, it's time for us to slip into a short break. Don't go anywhere. After the break, we get you all the news coming in on the domestic front. Welcome back. You're watching Market Cafe, and it is that time of the show where we get you all the domestic news. But before that, let's quickly see how the Asian markets have opened up. Now, Asian markets, I see a sea of red in the Asian markets. Asian Pacific markets are largely in the red as investors are really looking forward to the key data from Japan and China for this week. Now, Japan's gross domestic product for the second quarter will be out tomorrow, as well as its inflation print that is likely to come out on Friday. Now, China will also release its industrial production and retail sales for the month of July, as well as the house prices tomorrow. So key important data is likely to come out of China and Japan. And before that, we see the markets well in the red. Nikkei is down 178 points, more than 0.5% in trade right now. Let's quickly go across to the Chinese market also. We'll see the Kospi is also down. It is very, very flat right now, down just 17 points. Kospi also in the red. Let's go to Shanghai then. Shanghai is down 35 points, so down 1% in trade. So both Chinese and Japanese market well in the red before the key important inflation data is likely to come out, and we do see the ripple effect in the other Asian markets as well, because all the markets are in the red. Hang Seng also down 395 points, major cuts coming in there in the Chinese market. GIFT Nifty is down 46 points, ASX 200 also in the red, 34 points down, and GIFT Nifty, like I mentioned, down 41 points as of now, hinting towards a rather negative bias for the Indian markets at the start of Monday.
Absolutely, Ankita. GIFT Nifty not indicating a rather positive start. But before we move on with the show, let's take a look at the lineup we have for you on the market today. And at 9:20, we will be joined by N. Jayakumar, Managing Director of Prime Securities. And he will be sharing his view on where he sees the markets heading and the themes that he is currently positive on. Followed by that, at 9:30, we will be joined by Rajneesh Kumar, former chairman of SBI, and he will be talking about where he sees the banking sector and if the growth of the banks going ahead is intact. At 9:40, we will be joined by Sunita Reddy, MD of Apollo Hospitals, who will be here to talk about the company's growth roadmap ahead. At 9:50, we will have Manoj Verma, COO, and Rishabh Jain, CFO of Bikaji Foods International, and they will be talking about the demand trends that's currently trending in that sector. At 10 o'clock, we will be joined by Rajesh Prasad, Director of Finance of RVNL, and he will be talking about the orders that the company has bagged and the orders that the company expects to bag in the future. At 10:20, we will be joined by George Alexander Muthoot, who's the Managing Director of Muthoot Finance. He will be here to discuss the company's Q1 numbers. Remember, this company has posted an inline set of numbers for the quarter gone by. And lastly, at 10:45 a.m., we will be joined by Rajneesh Chopra of VA Tech Wabag, also here to discuss the company's Q1 numbers. Hi there, welcome back and still watching Market Cafe on ET Now. Let's get a move on with the show then. And with prices rising of rice, wheat and pulses, government is worried and taking steps to check prices of sugar in coming festive seasons. ET Now has learned from sources that all sugar mills are directed to maintain monthly sugar stock holding limits, and sale of sugar in excess of monthly release quota will be penalized. Samir Dikshit has more details. Take it away, Samir.
Clearly seems that the government is at the defensive position. Government is taking back-to-back steps so as to ensure that the prices of essential commodities, it remains under control, and also the availability is maintained in the market. And the latest move is regarding the sugar. The government has released an advisory to the sugar mill owners that they have to sell minimum 90% of the monthly quota that is being released to them. And if failing so, some disciplinary action might be taken against these sugar mill owners. So this advisory has been released last night. And this advisory also indicate the fact that there has been input that the government has been receiving, that there are traders, those who are indulged in hoarding practices, that they are artificially holding the sugar stock, and they are anticipating that seeking the upcoming festive season, the prices of sugar might escalate. Seeking the same, the government has came up with this advisory. But if we go by the numbers, the Sugar Mill Association, ISMA, has came up with the preliminary data that suggests that the production of sugar for the ongoing sugar season, that is October 2022 till September 2023, the sugar production is around 362 lakh metric ton, whereas the ethanol diversion will be somewhere around 45 lakh metric ton, and the available sugar will be somewhere around 317 lakh metric ton, whereas the domestic consumption stands, the estimate suggests that it will be 275 lakh metric ton, and this indicates that the government will be having enough stock of 45 lakh metric ton, and that is the reason that government is confident and has been echoing that the prices of sugar will be under control, especially during the upcoming festive season. The consumers won't have to face the heat of the rise in sugar prices. But there are inputs, as I have mentioned, that the traders are indulged in hoarding practices, and so as to check these sort of illegal activity, the government has released the advisory, and government has been constantly saying that the sugar availability in the market and the prices will remain under control.
All right, moving on then. Divestment of fertilizer PSUs is unlikely this fiscal year. ET now has learned from sources that government planned divestment of Hindustan Urvarak Rasayan, or HURL, is facing various issues. Prakash Priyadarshi has more details on this.
Yes, we are learning from our sources that disinvestment of fertilizer sector PSUs is unlikely to happen during the financial year 2024. As you are aware that the government is working on a strategy to divest fertilizer sector PSUs, starting with HURL, which is a joint venture company between NTPC, IOCL, CIL, HFCL and FCIL. Fertilizer Ministry has prepared a proposal for that, which was discussed with DIPUM as well. But now we are given to understand that the whole process has hit a fresh roadblock despite having in principle approval from the nodal ministries like coal, power and petroleum. Sources are also informing that companies in a joint venture have raised some concern before the government. Let's begin with the fertilizer sector PSUs, part of this joint venture. We are learning from our sources that these companies have raised a concern before the government, which is with regard to land cost. Companies like FCIL and HFCL have said during deliberation that they have provided land at very nominal cost, but the actual cost as per the market price is around 30,000 crore. Therefore, they want actual cost to be considered before moving ahead. When it comes to companies like IOCL, CIL and NTPC, they have raised some issue which is with regard to profitability on their investment. Company want better return on their investment incurred on revival of these fertilizer plants. Let's see how government is going to be resolve this issue before moving ahead with this investment process.
All right, thanks Prakash for all those details. Moving on then, insurance behemoth LIC is extending gains on the back of a robust Q1. ET Now's managing editor Nikunj Dalmia caught up with the chairperson of LIC, Siddharth Mohanty, on LIC's portfolio and investments in the Adani Group of stocks. Listen in to an excerpt of that conversation.
Team is there, they will take a call at appropriate time. We will calculate various things. We book profit also on various stocks. So let us see.
My whole question, sir, was purely about risk management, without getting into a yes or no in terms of when will you book profit or not. But in general, do you think your exposure to Adani Group of stocks, it really needs to be revisited purely in the spirit of risk management?
And that only one stock will not decide the risk assessment of LIC. Because if you see our portfolio, such a huge portfolio, and if you see the exposure to this group, it is very, very minimal. So that will not, and it is within overall risk framework. So whatever decision mitigation mechanism is to be taken for entire, so we can also take. But individual, we do not take as such. We don't decide this stock, that stock.
Okay. So if I conclude by saying that LIC's exposure to Adani Group of stocks is something which is not a concern, and unlike a lot of naysayers who would rate question mark on LIC's investment in Adani Group of stocks. At least now you've silenced your critics.
And I have told earlier also, we have never made any loss, rather we made good profit on this specific stock. Though we don't want to discuss any specific stock, because since you are asking, I can clarify that we have never made any loss.
Okay, appreciate that, sir. Now, how will FY24 be different for LIC from FY23? Things have normalized. You are getting, you're able to protect your market share. The persistency ratio seems to be improving. Do you think FY24 and FY25 could be the comeback years for LIC?
See, I can just share some initiatives we have taken, particularly on the digital front. This year, we are taking a big digital transformation project for entire operation of LIC, a huge digital transformation project. That will of course take time. Already process has been initiated. But besides that, we have also taken a project of customer onboarding through digital mode. So it will be for agents, it will be for banca, it will be also for our digital marketing or direct marketing. So through these three modes, we acquire customer. So these two projects will be undertaken. For this customer onboarding project, it will be effected, it will start working by the end of third quarter. So that in the current year, we will get definitely good result from this digital initiative.
Finally, what is the plan in place to maximize your current, fleet's current network? LIC has perhaps one of the most enviable networks. What is the plan in place to really, maximize on it?
All these initiatives we are taking to grow our net worth, and it is going, if you see from last year, our size has gone up to 46 lakh 11,000 crore.
And well, going across to ITC, which will also be reporting its quarterly results today, let's bring in my colleague Vinny to understand what we can expect from that set. Over to you, Vinny.
So yes, in terms of numbers that we're expecting from ITC, we're expecting a decline coming in the revenue, 2.3% decline in terms of revenue. Mainly that is going to be impacted by the agri business of the company. Profits of the company expected to see a growth on a year-on-year basis. EBITDA also expected to see an improvement. So operating performance, we're expecting an expansion coming in terms of the EBITDA margins as well. 37.5% is what we're expecting the overall EBITDA margins for ITC to come in at versus 32.7%. So yes, an expansion of around 450 to 500 basis points in terms of the EBITDA margins of the company. Cigarette volume, which we keep an eye out on very closely, that's expected to come in at around 7% for the company. Now, margin expansion, why is there a margin expansion? Owing to improvement in sales mix. Let's talk about individual businesses. So FMCG business, we're expecting a moderate growth coming in over there of around 11 to 12%. We're expecting the EBIT margins for the FMCG business also to see an expansion coming in. Cigarette business also is expected to do well, while agri business, that's where we are going to be seeing the dip, and that is what is going to be dragging down in terms of the overall revenue of the company as well, and that is because of the pricing of wheat. High base was there last year as well, so that is not expected this time around as well. And overall, hotels business is expected to do well, but paperboard business, maybe we could see a weak trend coming in. And paperboard business also could be a bit sluggish in terms of the revenue performance over there. Let's keep an eye out on the volume growth as well as the mix of the cigarette business. Any improvement on that front? FMCG EBIT margins, important factor to watch out for, and demand trends or any commentary on that sort is something that we should keep an eye out on, as well as the outlook that the company has for the agri business is something to watch out for. Let's not forget the company had announced the demerger of the hotels business as well. So yes, in terms of any more details on that front, in terms of approvals coming in from the board as well, that is expected as well with the numbers. So keeping an eye out on that one as well. Thanks, Vinny, for taking us through that. We will be keeping an eye on ITC in trade today on the back of its Q1 numbers. But let's stay with ITC then. And innovation and premiumization are aiding growth for the company, according to Sanjeev Puri, who is the CMD at ITC. Listen in to what he had to say about the growth roadmap for the FMCG major at the company's annual general meeting.
Indian brands that are globally competitive can foster substantial value retention in the domestic economy by creating robust supply chains within the country. This opportunity to contribute meaningfully to a Vikshit Bharat inspires your company to build its FMCG businesses at scale, powered by world-class brands that cater to evolving consumer aspirations. The ITC Next strategy of your company's FMCG businesses has redefined the critical pathways to growth and profitability by building a future-ready portfolio focused on fortifying and scaling mega brands, leveraging these brands to address value-added adjacencies, and crafting categories of the future. Innovation, brand investments, reach, and digitalization are driving premiumization as well as penetration-led growth. In a relatively short span of time, your company has built a portfolio of 25 plus vibrant brands in the FMCG businesses that represents an annual consumer spend of 29,000 crores. The hotels business has developed a bouquet of brands including ITC Hotels, Mementos, Welcome Hotels, Story, Welcome Heritage, and Fortune that address relevant customer need spaces and are receiving favorable response from asset owners. In the last 16 months alone, 18 hotels have been added, mostly through management contracts. Today, managed properties account for 55% of total rooms. As you're aware, the board of directors of your company has accorded its in-principle approval to the proposed demerger of the hotels business under a scheme of arrangement. The continued interest of ITC in the new entity will provide long-term stability and instill a sense of assurance amongst partners, investors, and employees, while enabling the new entity to leverage ITC's institutional strengths, including the timeless goodwill, world-class brands, and governance processes. For ITC, the reorganization will sharpen capital allocation, improve asset efficiency ratios, and unlock value for its shareholders, as well as enable leveraging of institutional synergies. Thus, the proposed reorganization will enable the business to architect the next horizon of growth as a pure-play hotels entity with a strong balance sheet, a healthy pipeline, especially when the industry is poised for robust growth.
All right, let's shift focus to HDFC Bank now. On the back of the key comments from their AGM, MD and CEO Shashidhar Jagdishan raises concerns over funding post the merger. Let's bring in my colleague Ankur with more details on this.
Yes, HDFC Bank is looking to induct former HDFC CFO into the board, and for that an application has already made to Reserve Bank of India. Apart from that, former HDFC CEO KK Mistry as well as MD of HDFC Renu Sood Karnad has already been inducted into the board of the merged entity, and apart from that, the CEO of HDFC Bank had highlighted in the AGM that there has been few risks which needs to be highlighted, and one of them is funding risk, and due to that there will be some pressure which bank might face. He cited the example of net interest margin, where there will be some pressure in the September quarter onwards because of the merger. Remember, the net interest margin of the bank remained at 4.1% in the Q1, but due to the merger there will be some pressure which will be felt later on. However, with the kind of growth the bank is aiming, it is looking to add another HDFC Bank in 4 to 5 years because with 18 to 20% growth. And due to that, there will be benefit of the bank. There will be benefit due to the housing loan portfolio which it has acquired from HDFC. Even the chairman of the bank had highlighted the same, that the credit growth and the large balance sheet of the bank will be beneficial for not only for the bank but for the economy.
All right, thanks Ankur for all those details. With that, let's quickly slip into a very short break. More news and updates on the other side as we come back. Hi there, welcome back, and thanks for staying tuned to Market Cafe. This is ET Now. Now, my colleague Vamakshi is standing by to take you through a list of all the stocks that the brokerages are keeping on their radar this morning. Good morning, Vamakshi. I believe you have notes from CLSA, JP Morgan, as well as Macquarie.
Well, yes, let me first start off with Nykaa. We have a couple of brokerages coming out on this counter on the back of its numbers. Let's first look at what the brokerages are saying. So they highlighted that the first quarter was weaker than expected for the company. There was a profit miss in the beauty segment that was actually offset by better than expected fashion performance. Near-term EPS growth headwinds are likely from weak apparel demand, but the headwinds along with competitive concerns from Reliance do make brokerages cautious. The pace of margin is also expected to be slower ahead. So all in all, we have Macquarie maintaining its underperformed rating. We have Bank of America downgrading their rating on Nykaa from to neutral. They've also gone ahead and cut their target price from 175 to 160, and Morgan Stanley, however, has maintained its overweight call with the target price of 175 rupees per share. Other than that, let's focus in on ONGC. We have a note coming in from Morgan Stanley, and they have highlighted that they do believe that the share price will rise in absolute terms over the next 60 days. ONGC stock is pricing in nearly 65 US dollars per barrel long-term oil price, and with improved global fuel demand dynamics, it should benefit on multiple accounts. So given all these factors, we have Morgan Stanley maintaining its overweight call with the target price of 206 rupees per share. And lastly, watch out for JSPL. We have a note coming in from CLSA, and they have highlighted that the first quarter results were ahead of what they were expecting, but the expansion plans that the company had outlined has been delayed again. The blended realization rose 1% on a sequential basis. Even the net debt saw a slight bit of a decline on quarter-on-quarter basis to 6,820 odd crores. So given all these factors, CLSA has lowered their rating to underperform from outperform, but nevertheless they've lifted their target price to rupees 720 per share. So largely on the back of all these brokerage notes, watch out for these counters.
All right, Vimakshi, thank you so much. We will be keeping a track of all the counters that you mentioned. But Lisa is also here with us in the studio with all the stocks that we need to keep on our radar for today's trading session. Lisa, tell us what are the stocks?
Well, good morning. Let's start with the earnings first. So ONGC has reported a beat in the numbers. The margin came at 52% versus 32% last year, and the operational number improvement, it was on the back of higher gas realization as well as lower profit petroleum prices. Nykaa reported a decent set of numbers. The revenue was up 9% on a sequential basis. PAT was also up 37% on a sequential basis. The beauty and personal care segment saw strong performance, and the contribution margin expansion saw an expansion of around 125 bips on year-on-year basis. Moving on to NMTC, even that reported good set of numbers. Revenue was up 13.2%. Profit stood at around 1,600 crore versus 1,471 crore last year. Margin was saw a tad bit of contraction. It stood at 37% versus 39% seen on year-on-year basis. Moving on to City Union Bank, the interest income, it was up 15%. NII, that was flat at around 522 crore. GNPA, that deteriorated by around 54 bips. Now moving on to other corporate announcement, Adani Port will also be in focus as Deloitte, the auditor of the Adani Ports, has resigned, and the company has informed that Deloitte has been an auditor since 2017, but they have also updated that MSKA and Associates from BDO, they have been appointed as the new auditor. And lastly, on Vedanta, the NCLT has approved the mining major acquisition of Meenakshi Energy, and the company said that it will be acquiring Meenakshi Energy for around 1,440 crore. So these are the stocks that will be on investors' radar for today.
Absolutely. Thanks, Lisa, for taking us through that list. And we will be keeping an eye out on all these stocks today. But moving on, in another edition of Mega MNC, we spoke to the global market leader in the beverage industry, Coca-Cola, who debunked misconceptions surrounding the alleged cancer-causing properties of aspartame, the road ahead and the expansion plans in India. Listen into what they had to say.
The ingredient in question is aspartame, which is there in Diet Coke. It does not exist in Coke Zero. Okay. So that's one thing. Aspartame, very interestingly, is one of the world's most researched food ingredient. So these concerns about aspartame is not a new one. Okay. It's been going on for the last 30 years. And across all the continents, most universities and most labs have done extremely detailed researches on this ingredient, and every time it has come out as completely safe. That's one. Secondly, if you actually go through the report of what came out, it doesn't say that aspartame causes cancer. Okay. It essentially says that if you have, say, around 15 to 20 products with aspartame in one go, you are in the same risk level as, example, aloe vera, okay, or red meat, or going to a barber shop. So if you actually go through the report, you have to get into the details. So absolutely, you should not worry about it. If you like your Diet Coke, like millions around the world do, just go and please continuing to have your Diet Coke.
And well, moving on then to a strong market voice, Ravi Dharamshi, who's the CIO of ValueQuest Investment Advisors, says that this is the beginning of a large trend for electronic manufacturing in India. He also shares his views on where he thinks the Indian chemical space is headed. Listen in to what he had to say.
This is the beginning of a large trend. India is still a very small player in the global scheme of things in the electronic manufacturing. And this China Plus One theme is not anymore a figment of imagination or a great boardroom talk or anything. That boardroom talk is now getting converted into inquiries, which is getting converted into orders. So while the world is actually slowing down or facing a slowdown, Indian small companies are actually facing fantastic demand. In fact, order books are getting swelled to the extent of next 3-4 years. So that tells you that this China Plus One is a real thing. But it is a theme that will move from sector to sector. It's not necessary that all sector face this kind of a demand situation across the board simultaneously. For example, chemicals is one sector which actually was early in this cycle. It started from 2014 when China was facing pollution issues. But now actually China is coming back in the chemicals market, and that is causing some demand as well as margin issues for the domestic players. But other sectors like renewables or the one you mentioned, electronic manufacturing, is just about picking up. So we are still doing low-end work. It's largely assembly work, but we will move up the value chain over a period of time as more and more OEMs like Samsung, Apple, all they set up their base in India. Even the semiconductor manufacturing players, that will give rise to the ecosystem in India, and we will also move up the value add chain.
So let's divide the market in perhaps 3 buckets. Less than 1 year, 1 to 3 year, 5 year plus. If you have to pick your spots in these 3 buckets where you think there is reasonable chance of outperformance, how would you divide the market? Less than 1 year, 1 to 3, 5 plus.
So, Nikunj, I'll refrain from commenting on less than 1 year. There is no way for me to figure out what will do well in 1 year. So, for example, pharma, we have remained largely out of market, but it's been the best performing sector in the last 1 month. And basically, we believe it's a reversion to mean trade, and it is not a secular upturn that is happening. So, some amount of when a market is undergoing a rotation, it usually happens that the relatively cheaper sector gets its own turn as well. So that's exactly what happened with pharma. But from a more 3 to 5 year perspective, and again, I will refrain from saying beyond 5 years also, because the world keeps changing drastically in 5 years' time. 3 to 5 years is where we are probabilistically likely to be more right than wrong. So on that time frame, I still believe that the manufacturing story will pan out. The overall India incorporates growth story, which will lead to re-leveraging cycle, that will pan out. The consumption should pick up. Currently, consumption is undergoing a tough period, and maybe another couple of 2 quarters, some amount of consumer discretionary pressure will remain, because the post-COVID revenge consumption that we saw is kind of subsiding, and that is leading to normalization. But post that normalization, I believe consumption-oriented companies should also start doing well. For example, real estate continues to be strong, but the ancillary to the real estate, the building material, should also start picking up. They are more a lagging sector to the real estate demand. So these are the sectors which I believe over a 3 to 5 year period should continue doing well. Capital goods is another. I mean, it's part of the manufacturing also, in the sense that the capital cycle is just picking up, and it is a very broad-based cycle. So these 4 sectors still look very good to us from the next 3 to 5 years perspective.
All right, that's the word coming in from Ravi Dharamshi. But let's move on to another market voice then. And Gautam Trivedi, managing partner at Nepean Capital, believes that another rate hike from the Fed will not hurt the global markets. But what are his views on the Indian markets? Listen in to find out.
Let's understand one very basic thing, which I think sometimes people, when I meet them socially, they think India is the only country in the world that seems to be having a stock market rally, and all the money in the world seems to be only coming here. Because if you read the financial newspapers or media channels, you almost get the feeling that we're alone in the world. But this is a global rally. Let's understand that. Year to date, the total amount in terms of market cap expansion of the world has gone up by $6 trillion. You've got the DAX, you've got the CAC, you've got the Nikkei at all-time highs, the Nifty 50, of course, all-time highs. These are real events that are happening across the world. So in spite of all of the war in the Ukraine, the price of oil, Saudi Arabia trying to keep the price of oil up, all of that has nothing to do with liquidity. Liquidity seems to be coming unabated, and I think that's what's really driving the markets right now.
So let's understand the global setup. Inflation is coming back. It could be tomato and onion, but it is corn, wheat, maize, and US residential prices, at least for the developed market. If the narrative changes, which is that from no more rate hike to one more coming, could that really act like a sledgehammer for the global setup, and could things really backfire?
I don't think so. Sledgehammer itself, you need something more significant than that to really impact global equity markets. So I don't think one more rate hike is really going to be the death knell. Now, the question really is, and I got this WhatsApp only this morning, and I assume it's mostly true, that the absolute amount of debt within the US systems, whether it's student loans, credit cards, auto loans, housing loans, etc., are at record highs. Now, does the US have the ability to actually service all of this debt? And will that additional 25 or 50 basis points rate hike by the Fed tip the scale towards a full-blown recession? I don't think so as yet.
Okay. If I look at your current portfolio construct, it's centered around banks. And a lot of banks, HDFC Bank, Axis Bank, ITFC Bank, ICICI Bank. The numbers are somewhat mixed for some of the banks. PSU banks have reported a drop in NIMs, whereas private banks, they continue to chug along smartly. What is in store for banks now?
So if you're right about that. If you look at the private sector banks on an aggregate basis, we've seen NII growth of about 27%. Again, this is for the first quarter results. You've seen a PPOP growth of as much as 34% and a 38% growth in PAT. So numbers have been spectacular. But going forward from here, I guess the one concern that we have is that NIMs have, I think, for the time being, peaked. Credit growth also, to some extent, has started to moderate from around 18 to 20% to about 14 to 15%. So I think from these levels, you will see probably moderate gains in the banks. Having said that, the bigger issue that I find within the banking sector, especially the corporate lending book, is the fact that no matter which company I meet, every promoter seems to be having only one agenda: how soon can I get to net debt zero, or in some cases, net cash. So there seems to be a huge aversion to debt, and that this obviously began pre-COVID when the entire NPL problem blew up in our face. And since then, a week doesn't go by when I meet a promoter who says, "I want to be debt-free as soon as possible." So that is a concern from a corporate lending book.
Gautam, hi, morning firstly. We were just discussing in the morning as to what then is the core portfolio strategy. Be lazy, that's going to work out best. Don't try and venture into leverage trades.
Yeah, I think, I don't know. I don't think leverage is such a bad thing, first of all. So, when these promoters say that, and I say, little leverage is only good for you. It's good for your ROE. But I guess I think the impression they seem to have is that lower the debt, better perception from an investor's perspective, and a better market cap. So that's at least the way they seem to be, I think, thinking about it. But
all right, let's also take a look at other news and updates coming in. And in a series decider, then in the T20 series decider, West Indies beat India by 8 wickets to win the final match of the 5-match series at Florida. West Indies had previously only defeated India at a bilateral series in 2016. At least 18 patients admitted at the civic-run Chhatrapati Shivaji Maharaj Memorial in Thane lost their lives in the span of 24 hours. Sharad Pawar has called it a failure on administration's part. Chief Minister Shinde has informed a high-level panel to probe into the lapses in treatment, and earlier this month, 5 patients died on the 10th of August, taking the death toll up to 23.
And ahead of Independence Day celebrations, security arrangements at the national capital have been ramped up. Over 3,000 traffic police personnel will be deployed, and security at the Red Fort has also been tightened, and movement of commercial and heavy vehicles coming from Ghaziabad and Noida will be restricted entry into the capital from Monday night till the August 15th. And Rahul Gandhi is on a 2-day visit to his Lok Sabha constituency, Wayanad. This was his first visit since the reinstatement as MP. During the visit, he said that continuing violence in Manipur is disturbing. In one of the events, he also pitched for tribal rights.
And as prices continue to soar, the NCCF sold 71,500 kilos of tomatoes at a subsidized rate in Delhi at the 2-day mega sale held ahead of Independence Day celebrations in order to provide relief to consumers.
And with that, we're completely out of time for this edition of Market Cafe. Snehi and I will take your leave. Don't go anywhere. There's lots more coming up on the market. Thank you so much for tuning in and wishing all the viewers a very happy Independence Day.